In this episode, we speak with Darren Cohen, the Co-Head and CIO of the Goldman Sachs Growth Equity team, a position he has held since 2018. Darren manages a $5.2 billion global growth fund and oversees one of the largest dedicated growth equity platforms in the world, focused on the enterprise software, financial technology, and healthcare technology sectors. He manages a talented, diverse team of over 80 investors and collaborates with world-class operating advisors to accelerate value creation across the portfolio. Darren is an accomplished technology investor with a 25-plus year career spanning public and private global markets. His investment journey began with a strong foundation in fundamental research, honed during his tenure as a technology research analyst in Goldman Investment Research and as a buy-side analyst at a global hedge fund. I'm your host, RJ Lumba. We hope you enjoy the show. If you like the episode, click to follow.
RJ Lumba is the managing partner of Growth Cap and the executive chairman of Market Insight Media. He is the host of Growth Investor, a podcast featuring today's best investors, executives, and founders. In the minutes ahead, we'll uncover insights and strategies for accelerating growth and succeeding in business.
Darren, thank you so much for taking the time to chat with us today. It's a delight to be with you.
Thanks, RJ. Excited to be here.
So I think this is the first time we're having Goldman Sachs on the show. The obvious question, to me at least, is how your firm sits within the broader GS ecosystem. And then we'll get into, because I imagine there's a lot of synergies, but maybe we'll start there if that works.
Yeah, no, happy to provide context. So I run our growth equity team. It's a global team. We have 80 investors. As many of you may have been following, Goldman has been through a series of, I would say, strategic decisions over the last few years to really double down on our alts business. Many of you in the world who have co-invested with us have known that Goldman's been pretty prolific in both venture and growth for almost 2 decades. So this is a strategy that we used to deploy just simply on balance sheets. So it was funded by the firm, and it existed in different divisions. And thoughtfully, when the CEO transition happened in, call it 2017-18, one of the key strategic decisions was to aggregate all of our alternatives businesses into one division. And then ultimately that became part of AWM, which is Asset and Wealth Management. So the alts businesses basically got consolidated into really 4 flagship platforms. There's real estate, credit, corporate equity, which is buyout, and growth equity. So the growth equity business is now relatively simple. It's just one team targeting high growth, for the most part, software businesses globally. And we raised our first fund in 2021. So everything we do from here on out is going to be fund driven.
Very interesting. The switch over and how it was repositioned within the firm, does that mean that there's more of a tie-in to the wealth management space versus, I guess, a distinct asset management division that's more institutionally focused?
Yeah, so from a structural perspective, the 2 businesses have a lot of adjacencies and strategic synergies between wealth management and asset management. But in reality, like even within asset management, what many people don't know is so if you think about our asset manager, it's both a public asset manager, so think BlackRock, and a private alternatives asset manager. We're actually top 5 in both, which is pretty unique. I think that's what, if you think about Goldman's forward, it's one of the most interesting strategic dimensions is we actually have scale in alts and we have scale in public investing, both in equities and fixed income. In reality, the way those businesses are run, they're pretty much run as distinct franchises. So the alts businesses run in its own cadence. And in some cases, it's structural. We're private, so we're behind the firewall. In some cases, and then the public teams run their own cadence. And then wealth management and advisory, obviously, it's its own business with its own unique business model. But within the umbrella of AWM, there's a lot of synergies. And that's where these businesses kind of work together. So an example would be for Growth Fund 1, a significant amount of our capital came from our high net worth client base because this was a strategy they could never actually direct investing in. And the whole point of us pivoting and beginning to open up these strategies is to enable our clients to invest with us. So in Fund 1, the employees put $1 billion in, the firm put 500 in, and we also were beneficial. We had a very significant influx of capital from our high net worth clients. That's part of what enabled us to raise $5.2 billion, which is a very large first-time fund.
Very interesting. Yeah, I can see the synergies on both ends, both from deal making, deal sourcing, as well as where the capital is coming from. Now, switching over onto the deal side, from the outsider's perspective, it's like, oh, they have great reach into sectors. and they have relationships with CEOs and founders, and maybe it's probably a natural thing for them to get deal flow. Does it work that way, or do you do a lot of outbound?
Yeah, so it's a combination. You're absolutely right. Your premise is, look, we have a tremendous amount of sourcing capability, partly because of the brand recognition. People know Goldman, and they will always open the doors when we ask. But in reality, the strategy is very balanced. So we have 80 investors. We have a very deep team of analysts, associates, and VPs. We're all sector aligned. And the teams do a tremendous amount of outbound calling to drive deal flow that's very thematic. So there's that motion, which is probably, I would actually say, the majority of our deal flow. And it's typically direct bilateral conversations that evolve over 12, 24 months with us building relationships with founders and CEOs. But you're absolutely right. One of the benefits of being on Goldman's platform is we have tremendous ability to source from other channels. So, interestingly enough, our banking franchise always comes to mind, which is very true. And if you look at, I would say, two hallmark deals, both Canva and Stripe, that we led and we were very active in, came through our banking franchise. So if we're going to invest late stage growth, I think that's a really interesting channel. But interestingly, some of our best opportunities come from our engineering team. So we have 10,000 engineers at Goldman, and our enterprise software teams are very much integrated and work in a very collaborative way with those engineers to go deep on like thematics, vendors, diligence, and then ongoing advisory, R&D strategy. There's just a huge synergistic effect of our enterprise team with our engineering group. And that's an area of terrific deal flow. Enterprise software is around 50% of what we do. And then fintech is about 30%, and healthcare software is 20%. And in the fintech landscape, you can imagine the firm has just insane connectivity to the entire ecosystem and domain expertise in almost every area, as well as client access. And so the fintech vertical gets a huge amount of edge from being within the Goldman ecosystem. And then in healthcare, it's a sector we're building into because I love it as a thematic, and there's just tons of opportunity and less competition. But we also have a great franchise in healthcare banking and are deeply connected in many different ways with all parts of the healthcare ecosystem. So part of the reason why I think our team loves being on this platform is just the alpha and the edge you get, whether it's sourcing, diligence, or value creation. It's pretty real.
We'll head into these three areas in a bit. I'd love to touch on your background because it seems like you came from the public investing side and hedge fund world, if I have that correct.
Yeah, so my background was probably non-traditional for an alts manager. Came out of school, went into technology consulting, went into investment banking on the research side. So I was actually a sell-side research analyst in the late 90s and at Goldman in 2000. Did that for almost 6 years. And then in 2004, I shifted to the public side, but at a hedge fund manager. So I did that, had an awesome experience for 4 years. And then I came back to the firm in '07 in a strategic investing capacity, where I helped build up probably one of the largest strategic investing teams focused on financial technology and enterprise software. It was a couple $1 billion. And we were at the epicenter of a lot of the innovation that happened in the capital markets. So we built trading platforms. We would incubate them as ideas. We would fund them. We would build those companies with our management teams and then ultimately bring the rest of Wall Street behind them. So that was sort of the arc of that fintech activity. And then I had the pleasure to work for Marty Chavez, who became our CTO and then our CFO. And that brought us into enterprise software. So my background's kind of evolved. It's 10 years on the public side, and then just over 15 years on the private side.
Yeah, what's amazing is I was looking at the team for, Goldman Sachs Growth Equity, and many of your colleagues have been there for a very long time. And I think that's similar to other parts of the firm. What is it about the GS culture that keeps people at the firm?
Yeah, it's hard to articulate in a very succinct way. I would just say, look, we appreciate the opportunity, I would say, to compete at the highest level. Goldman gives you a foundation that in whatever capacity you're working in, you have the ability to be in the most interesting conversations, the most interesting opportunities, whether it's capital, expertise, reach, access, you have it. You're surrounded by phenomenal talent. And I think it's easy to take it for granted, but it's really fortunate. Everyone around us, whether it's front office, back office, senior, junior, there's a certain level of quality. And that's honestly a privilege to work in. I've been obsessed with in growth of building a culture that's hyper collaborative. You know the venture growth space quite well. In many cases, it's like solo practitioners or silo teams. We've gone above and beyond to create like a very integrated, collaborative approach to everything we do in investing, whether it's on the investor side or on the operating advisor side. We work as one integrated team. And I think the function is the team enjoys it and they have a great experience. and they're competing for the best opportunities. They're learning, they're growing. It's hard to leave. It's actually a really great foundational platform with a tremendous amount of stability. And what's also, I think, a unique moment in time is alternatives is a massive focus for the firm in terms of its strategic agenda. So everyone who's on this platform feels the weight and the support of our leadership team. And you want to be in that space, which is Goldman's leaning in, and we're trying to build and scale these franchises. So that's actually a lot of fun.
And you have a sizable AUM within growth compared to some of the other growth equity firms. It's not like one of the biggest out there, but is the goal to grow AUM dramatically within the growth side?
Yeah. So my own view is I just want to be thoughtful about it. We're at, I think, 12 billion today in AUM with never really focused. We used to do this on balance sheet. And so we had principal returns, and those principal returns are highly accretive. When we shifted to, the fund, I think one of my real priorities was don't shift the strategy. The strategy's generated phenomenal returns in the 20s for 2 decades. Let's not change it, but let's grow the team, grow the asset base over time. And I think we'll be super thoughtful about it. Like we'll start fundraising next year. Fund two will be relatively similar to fund one in terms of size and composition. And if you actually look at how the model grows over time, you can easily see it growing to 15 or 20 billion in the next, I would say, 5 to 8 years as we get into fund two and fund three. But I would say the constraining factor for me, I'm very focused on making sure our senior leadership teams that are leading deals are very active in the deals we go after and are very selective. I almost limit them to working on 5 or 8 deals in their portfolio. And so I don't want to get into a situation where we have senior leads managing portfolios that are too big to take the attention and care that's needed to help these companies scale and grow. I think that's the one way to break a model. So I think there's a balance. My goal is not to be the biggest growth fund, it's to be one of the best and consistently performing. We were able to navigate the 2021 dislocation into 22 pretty well. And I feel like we're set up to do well and just continue to be pretty pragmatic around how we build the team, build the capital base. But ironically, I don't think growth is one of those things that just scales infinitely. I think you have to be very careful on how much capital you're taking, how big is your team, is it the right balance? Because when that balance gets out of whack, people start making decisions for the wrong reasons.
I think we've been increasingly hearing about the large PE firms in a way democratizing private equity and giving the retail segment of the market more access. So there's a drive from the PE side. And the question that always pops in my head is the appetite there on the retail side. They have financial advisors that tell them, you should get more exposure to alts. And then maybe here are the different asset classes within alts. Are you sensing the same thing? Is there a drive among financial advisors or the retail channel to get access to more?
It's almost, I would say at this point, uncontroversial to say there's just massive demand from retail at all different levels to increase their exposure to alternative, to diversify their asset mix, to drive longer term returns or superior returns. So you're seeing a ton of demand. What you're also seeing is product innovation that unlocks part of that retail channel. Because honestly, like the drawdown funds are not perfectly designed. And in many cases, retail investors can't even satisfy the minimum liquidity requirements. So as the semi-liquid funds start to come to market and that becomes more of a retail product, it feels like product innovation is going to meet the demand for retail and those products are going to scale. So I do think it's an exciting time where you're seeing more demand from a more diverse client base, which I think is really healthy for the ecosystem. But I do think it'll take time because these products need to evolve. The channels need to evolve. One of our interesting big investable themes is private market infrastructure. In order for the private markets to really scale, you've got to have digital platforms, digital subscription docs. And so we've made a series of investments in that space collectively. And that's sort of where empirically I can look at how well those companies are doing in the demand. And I'm like, oh, yeah, it's working. Retail is definitely interested. You're seeing some of these distribution curves really take off. But we're so far away from like maturity or even a level of infrastructure that you look at capital markets on the public side, it went through that transformation 3 decades ago. I would say alternatives is just beginning that migration.
I mean, this is a very tough question, but why is it so hard to democratize the private markets? You would think someone would have figured it out by now.
I'd say it's a series of different dimensions. The product itself, I'd say by construction is generally a liquid. There's longer durations, longer hold periods, depends on the strategy. And for a retail investor, that can be an issue in terms of consistency and getting access to liquidity. So that's one issue. Second issue is just the way these products are designed and the drawdown capacity. It's a more complicated product, and it has tax implications and reporting implications that look very different than public markets. So there's a dimension of just product and product friction, and then there's distribution and there's education. And so all of those dimensions need to be built out and scaled for retail investors to understand what are they buying, what are the weaknesses, the strengths, how does it actually work, how do I get access to it, how do I value it. And that's where the product innovation happening isn't perfect, but it's starting to address it. And I think when you're dealing with asset class transformation, it takes decades, not years, to see these transformations. And I think obviously alts is going through that transformation. And I think it's different by every asset class: real estate, credit, equity. They all look very, very different.
Mm-hmm. Do you think that we'll ever go back to a time where maybe the regulators say like, okay, there's enough people out there that now don't have access, and so we need to liberalize this a little bit?
I'm not that close to all of the most cutting edge changes in regulation, but I do think the regulators are definitely more open minded to creating a path to get access to a broader group of retail than existed in the past. And so you're seeing thresholds change. You're seeing some of the new product innovations kind of addressing the regulatory needs. So I do think that's a constructive dialogue, and it's moving in the right direction, because net it is positive to get a broader universe access to these products, because they do generate good returns over a long time periods, and they also create some level of alpha and diversification. So it's pretty constructive.
Mhm.
And you look at some of the successful semi-liquid products that have been launched in the industry. I mean, there's obvious ones on the real estate side. They've scaled dramatically. They may not be perfect products, but they've given access to an asset class that most retail investors have not been able to get access to.
Touching on the sectors you focus on, I'd love to hear your thoughts on like maybe some interesting areas you find particularly compelling and maybe thematically you're diving into. So let's start with enterprise software.
Yeah, so in the enterprise software space, we're seeing innovation, and obviously there's an AI overlay over just about any of these sectors, whether it's enterprise fintech or healthcare. We're seeing the pervasive impact of AI, but maybe just to be more specific in enterprise, if I look at our Fund One investment, some of the most interesting opportunities are around robotics. We've invested in the leader in Europe, the leader in the US, and it's about warehouse automation. And obviously during COVID, that became a massive choke point. And I think we're still in a very early innings of seeing that automation curve scale, and also just the robotics continue to advance, and the cost of buying the robotics come dramatically down while labor costs are going higher. So huge market opportunity, kind of a complicated technical space to attack. That's an obvious one. I would say, and Exotech and Locus are the companies we backed in those spaces. Another really interesting space in enterprise is sort of the knowledge worker and market intelligence. We backed a company called AlphaSense roughly 3-4 years ago. They do basically market intelligence at scale. They aggregate thousands of publications and apply machine learning to it to help, for the most part, originally investors get access to interesting content and research. And then they added semantic layers to it, sentiment analytics. And now they've expanded into the corporate universe, and they have thousands of corporates now using their technology to do market research. That's a whole space that with generative AI, you can imagine just being able to do smart summaries on topics, on companies. It's kind of stunning. Cybersecurity is an obvious theme in enterprise. In the infrastructure side, as the world moves cloud, most of the global 2000s actually move in multi-cloud, and that creates a whole series of architectural challenges. So we're working with our engineers to identify companies, whether it's in security or networking, that are really optimized to help corporations deal in a multi-cloud environment, because that'll be a domain that really exists outside of any one particular cloud provider. Switching gears in fintech, I talked a little bit about private markets. I think that's a phenomenal theme that is just in the early innings. There really aren't that many companies that scale. We've invested in companies like Carta and iCapital. The other area of fintech, which has been covered quite pervasively, is just embedded payments and finance. And so when you take vertical software, you combine it with a payments layer, there's just an ability to create companies that are extremely, extremely valuable. Even though the actual core market may be narrow, the ability to add payments drives a tremendous amount of value creation. And then lastly, healthcare. I think healthcare is an area where software is really finally starting to drive a lot of innovation. And that, I think, accelerated post-COVID as large healthcare systems just realized they had to change the way they deliver patient care. And we've backed, just one example would be if you look at what's going on with the mental health crisis, we've backed, I would say, two of the winners that are providing access to psychologists, psychiatrists at scale. Growth therapies, one, Connects is another. And they're multi-sided networks connecting patients with physicians and providers and payers all through software. And it unlocks just massive value across that ecosystem. So it's an interesting moment in growth right now where I think if I look at the technology trends, they're as pervasive, as healthy as I've ever seen them. And as a function of the environment and the multiples dislocating and now resetting, it ends up being a pretty interesting backdrop for growth equity investing.
hmm And how much, because I know you invest across kind of the company life cycle and at different maybe thresholds, revenue thresholds. How much of what you do you feel like is true growth equity, profitable, good EBITDA margins
Yeah.
versus venture?
The way I would define our curve, and you're right, we do invest across the spectrum, early, mid, late stage growth. From a venture perspective, at least our definition is really defined as, do you still have product risk or market risk? And typically, for the most part, across most of our sectors, by the time the companies have north of 10 million, 15 million in revenue, you have dozens of clients you can do research on, you have the economics generally proven. Now, how those businesses scale is, I think, the area of where there's risk. If you look across just fund one as an example, it's about a third early stage, a third mid stage, and a third late stage. And, if I think about what I would define as growth, the commonality amongst early, mid, late is that you're dealing with management teams that I think have taken out the risk of product of market. And it's about execution risk. It's about capital and talent. Now, at every stage, there's a different series of challenges. And I think the way we've designed the platform is perfectly suited to that CEO and founder who wants an investor who can invest across stages. The capital base will typically write $20 to $200 million checks. We can scale it to $1 billion with BWM. And then we bring a series of capabilities, whether it's our advisors, our bankers, our engineers, our network of clients to help those companies scale through each of those periods. I would say from a profitability perspective, we obsess about unit economics, but there are many situations where you're dealing with high growth companies that are in a unique competitive position. And honestly, profitability is not what we're optimizing for. It's like product R&D, breadth and scale, penetration, with a real focus on how the unit economics are improving and how the path to profitability is becoming increasingly clear and realized. And then typically that flips by the time you get late stage, you're at a point of break even or profitability. And now you're looking at a balance between growth and profitability and margin expansion. And it's kind of interesting to look through fund one. You can almost see it year by year. It starts with in fund one, 30 or 40 or $50 million burn on average. You get to like break even in year two, by year three, you're profitable. And RJ, that's partly a design of how we look at risk. We historically have not backed companies that are burning hundreds of millions, if not billions. Those models are just too capital intensive for us. And to your underlying question, I actually think growth, if it's done right, you actually have very little capital impairment. You're dealing with companies that aren't levered, very well funded, very good unit economics. And our loss ratios are like 10%. So they're very, very low. So most of the companies, when we do see a burn, you have a pretty good feel for how do you fund it and how do you get to the other side. But as you know, the psychology around growth and profitability has changed over the last 4 or 5 years. Our CEOs are much more sensitive, aware of the need to balance growth and profitability.
I have a few questions left. One of the questions was, and I always asked this earlier on, but we had a lot of interesting topics to cover. But what do you usually inform founder CEOs of the benefits of partnering with Goldman versus someone else? I mean, I could probably come up with a laundry list, but what do you usually try to point
That's a softball question. I'm happy to take that.
out?
I would frame it in a couple dimensions. One is it's always about a connection with the investing team. You got to start there. We have teams, to your point, that have a lot of tenure experience. And I would say by design are very collaborative and have great references. Like part of the ethos for the group is I want our CEOs to have an amazing founder experience working with us. And I want us to show real value at all stages. So it's partly team. I would say capital is a massive edge. I would say there are very few growth funds that can invest 20 million and actually make it meaningful, invest 200 and then potentially scale to $1 billion. So if you're a CEO founder, you're like, that would actually be really amazing to have someone who can scale with me. The operating advisor capabilities we've built, this is something that was a real passion project 5 years ago, and it's turned out to be even better than I think we expected. So we have 100 operating advisors on our platform. We actually partner with our corporate equity team. So those advisors work across both. but we have about 40 advisors that are dedicated to growth. They're in the areas of talent, go-to-market, finance strategy, and product and technology. Just to give you a sense of the level of activity and engagement. So 100% of the Growth Fund 1 companies have used the advisors. The advisors have spent 10,000 hours with those companies across all these dimensions. So it's an incredibly active strategy. And by design, when we actually look to bid on opportunities, those advisors become a part of that process and they connect with the management teams. And so a lot of the reason why the founders and CEOs want to work with us is because what they see is an integrated team of investors and advisors working together that can help them scale more efficiently, more effectively. And that's just within, I would say, the growth platform. And then outside of the growth platform, the ability to tap into our bankers who are fantastic in all their different domains, but also the client network. So we have north of 10,000 banking clients that we can get access to. We have a phenomenal degree of penetration and reach across financial services. And then we have our high net worth clients. So whether it's board advisors, getting access to clients, getting insights into any topics, it could be government affairs, legal, regulatory. The beauty of Goldman is we have the expertise across the firm and we're global. And I would say for the companies in the US that want to expand into Europe or the European companies that want to expand into the US, having a globally recognized brand, but also a team and a platform that scales globally, I think is increasingly relevant. And then last but not least is just the connectivity we have within the engineering universe, but also just technology broadly. So there's a set of capabilities and network access that when you combine it and you deploy it over time, our relationships are 5 to 10 years with these CEOs. At any given point, they're going to need something, and generally we're in a position to help them. So it's certainly an area we're focused on. It's an area where we just want to deliver outsized value. And I think if you talk to the CEOs in our network who have experienced it, it's very different. What I'm actually really focused on is it's got to be real. The CEOs, they got to feel it. They got to talk about it. And I would say, one of the dynamics that have changed in the last 3 or 4 years is as we've gone through this dislocation, there are very few funds that have been completely committed, and we've been pretty thoughtful about how we deploy capital. But the CEOs on this platform have had an awesome experience. And I think it's that kind of moment when the best CEOs are going to work with the platforms that have been able to deliver that kind of experience consistently through time. So it's kind of core to the strategy.
Excellent. Last 2 questions. We could do this rapid fire. Can you tell us about a person who has had a profound influence on you?
Great question. One of our advisors, his name's John Connolly. He's our lead growth advisor. He's been a CEO, I think, 5 times. And he's actually helped build some of these venture platforms and these operating advisor platforms over and over again. It's just kind of stunning to come to work every day with someone with that level of experience and just an insane degree of commitment and passion for giving back. It's been awesome. It's one of the joys of my work is we've built this operating advisor team of just phenomenally proven, talented people that for the most part, and people ask me why do they spend so much time with these companies? They just want to give back. They want to be part of that ecosystem. And that's a very cool part of my job.
Last question. Can you tell us about a charity, cause, or other endeavor that you're passionate about?
Yeah, I've been very involved with my university. I went there as a college grad. I studied philosophy, never went back to get a business degree, met my wife there. And I've had nieces, nephews, sister-in-laws all go there. It's just been an amazing part of my experience and being able to give back and provide scholarships to the students, but also help the liberal arts university transition into a modern world. It's been a lot of fun and there's a lot of great people around it.
Excellent. Well, Darren, I want to thank you again for taking the time to chat with us today. It's been a wonderful conversation.
Great. RJ, thank you for the time. Appreciate it.